All right, so calculation of income tax, we already went through what that calculation is, but we'll look at these, some of these examples here. So, if you recall in payroll accounting, you could use the percentage method the percentage method instead of the wage bracket method remember the percentage method was a table, right? We were using just the tables. We'd look up the income and all that, but the tables only go up to a certain point, right? And if your income fell off of that table, then you had to use the wage bracket method to do the calculation. We have a similar method here with income tax. So if your taxable income is 100,000 or below, you can just use a table. Okay, easy peasy. Just use the table, choose the filing status, and bang, you can figure out the tax liability. If the taxable income though is over $100,000, then you've got to use the method that we just used. But you can use that more simplified method in Appendix F that I just showed you. So the tables are in Appendix D, but the simplified tables are in Appendix D. The other more complex calculation, we looked at Appendix F. So if we look at, let me see if I can, so here's the tables. So looks pretty similar. So your taxable income, so we've already got to this point. And by the way, I'm going to give you a little hint. Some of your problems assume that you know more than you do. If they use the term taxable income, they've already subtracted the deductions. That standard deduction has already been subtracted. However, in your problem, if they use the word total income, or they use the term W-2 income is also total income. That means it's before the deductions. So you're going to have to subtract that standard deduction. They're giving you the filing status. And remember, on the form, that standard deduction was right there on the 1040 form. It's listed there for you. So if you get a problem that says, you know, Joseph has W-2 income of $70,000 and he's single, figure out what his tax liability is. Know that it's W-2 income, so it's total income. You're going to have to subtract the standard deduction for a single individual. Okay? If they say Joseph is single and his taxable income is $70,000, they've already subtracted it. Okay? So be careful of that wording. Like I said, they assume, they're assuming that you know more than you do in chapter 1. But so I wanted to point that out, that's something that comes up. Okay. So this is, we find our taxable income. So let's say we've got, I don't know, $65,000 of taxable income and they're single. So so remember in payroll accounting, I told you to go to the second line. If it's right on the line, go to the second line. You remember that? Does everybody remember that? So like if it falls like 65,000, it says 64,950 to 65,000, but then we've got another line that says, thank you. Maybe you should just sit back there. Well, we have another line that says 65,000 to 6550. So you want to use the second line. So if it falls right on the line, you want to use the second one. So 65,000 and they're single. So these are all filing statuses. First column is single. 65,000, 93.59 is the tax. So very simple. If you could just look it up on the table, right? So that's there. Okay, so for example, Denby is a single taxpayer, taxable income of $42,787. If we were to look at that tax table, which I'm not going to go to right now, his income would fall between that $42,750 and $42,800. If he's single, which they told us they're single, it gives us a tax of $49,001. Okay, just remember that $100,000, and it doesn't matter what the filing status is, $100,000 is the cutoff. So if the income is $100,000 or less, you're going to be able to find it on the table. But be careful of your problems. Make sure, because they may tell you, and I know you've got a problem that asks you to do it both ways. So even though it's under $100,000, it still wants you to do it the other way as well. Because you'll notice that this is going to give you a round number. The other method is most times it's going to be a little bit different, because this is a range of income, whereas when we're doing the calculation, it's exact. Right? So it might be, so I know you've got some problems where they want you to do both, and so you'll see that it might be just a little bit different. This one, same sort of thing, but they're married filing joint, taxable income $44,059. So if we were to look at the table, it falls between $44,050 and $44,100. Tax liability is $48,025. So it's just that one table that you have to look at, because all the filing statuses are on the same table. Let's see. So, they do point out here, notice single, married, tax liability. It's not actually that different. 48. Well, you can kind of see here. So this is a single, a single taxpayer. Income is $42,787. This is these are married taxpayers, $44,059. So their income is higher than this single individual, but the single individual has a higher tax than the married couple. It's not much higher. I would have expected it to be a lot higher than that. The difference. So just showing you the difference between the different filing statuses. Let's see. Okay, so here's an example of which we did this. This is the method that we did before. So we got Bill and Andrea, married, taxable income $48,305. If we were to use the tax tables, their tax liability is $53,35. If we do the calculation, though, the calculation that we did before, so that first bucket at 10%, and then in the next bucket at 12%, they've got whatever this amount of income is, that's the tax, so their total tax is $53,32.60. So this shows you how it's just a little bit different, because this is more precise than this. So you'd probably want to use this to save your, what, $2.40. Every penny counts. So you can use whichever one is most advantageous. In your real life, you can use whichever one is most advantageous. Oh, let's see. All right, so that's our tax calculation, which we